Good morning and welcome to the latest special edition of the Sharesify podcast. Today we're delighted to be joined by Guy Anderson of Mercantile Investment Trust. Now, Mercantile is one of the largest and most illustrious UK trusts dating back over 140 years. The trust focuses on UK companies outside the FTSE 100, which it can believe can be tomorrow's market leaders, and targets annual dividend growth above the rate of inflation. Now, its successful track record means it's one of a select group of AIC millionaire makers. What does that mean? Well, if you'd invested the full ISA allowance, including dividends from 1999 to 2025, you'd have a pot of nearly 1.25 million. Guy, welcome to the podcast.
Hi, thank you. Happy to be here.
Excellent. Now, when you're looking for tomorrow's market leaders, which qualities attract you to a company?
So first and foremost, we're looking to deliver that long-term capital growth, as you mentioned. And so we think that it's really important to invest in individual companies. So it's a portfolio built on a bottom-up stock basis. And we're looking for those companies that we think have strong quality credentials, so have good margins, good profitability, generate good cash, and which can then reinvest that capital, that cash that they generate, to drive future growth and thus compound returns over time.
Got you. As you said, we were discussing off camera, you're a mid-cap trust, really. So it's companies outside the FTSE 100. But some of your holdings even so are quite large. And is that because you've run them a long time?
Yeah, that's right. So we look to invest in both mid and small caps. So we cover that full spectrum below the FTSE 100. But as you say, we do have a number of holdings which have sort of progressed from being small caps to mid caps and then ultimately up into the FTSE 100. And we will often choose to retain those positions. So we're not forced sellers once they're moved up into the FTSE 100. What we do though is we keep a lid on the total amount of the portfolio that's in the FTSE 100. We keep it below around 20%, just to ensure we don't have a size drift over time, so that we are staying true to being mid and small cap investors. But yeah, we have 10 names in the portfolio today which are in the FTSE 100. Each of those was previously either a small cap or a mid cap. So in the case of Games Workshop, one of our largest holdings, we've held that since it was a small cap. But there are many in there that we've held since mid caps and they've been promoted up. And Diploma's another good example, or ICG or 3i, etc.
Excellent. And yeah, Guy, could you tell us a bit more about your sell discipline? So what do you do when stocks underperform? Sort of Bellway comes to mind. Just give us a bit more detail.
Sure, absolutely. I think it's really important. One of the things that as a team we're really keen on is that we maintain a rigorous but disciplined investment process, and that discipline has to come from the start of an investment all the way through to its end, i.e. its sale. And so what we do is we will have, I guess, within the portfolio, there's a constant competition for capital. So we're looking for, we have a portfolio today which has roughly 75 holdings. We're always looking for those holdings which we think are going to be the best ones looking forward from today. And so if a stock has underperformed for whatever reason, then ultimately it will be reassessed and we will either choose to include it or exclude it. If it has operationally underperformed and is not meeting our expectations, then of course it's far more likely that the investment case is broken, and therefore if an investment case is broken, our default will be to cut that position, recycle the capital. But of course we've got to consider the whole market context, what might be driving that underperformance. Is it short term, is it long term in nature, and then of course what's happened to the valuation of the shares. But I think the key point is being very disciplined about, if something breaks, we cut it and we move on, rather than just holding on to a company today because we happen to own it yesterday, last month, last year. The portfolio today is what we choose to own today for the future, not based on the past.
Yeah, absolutely. I noticed you've in your latest update, you've got a relatively high level of gearing, Guy. I think it's 17% and the limit is 20. So I'm interested in that. Does that mean you see a lot of opportunities out there? And do you remember the last time you were that geared?
Yes, so as you say, you're bang on. It's pretty high today. So yeah, as of this morning, I think it's 16.5%. When I look back over history, that is definitely at the top end of the range that we've operated in. One of the great benefits of an investment trust is the ability to deploy that gearing. So we've got this long-term fixed cost debt that costs us in aggregate about 4%. And of course, we look to deploy that to enhance returns to shareholders, but we are we're strategic and tactical about how we deploy that gearing. And so having an elevated gearing is a clear sign of our positivity or the number of opportunities that we're seeing. A lot of it is driven, of course, it's driven by top-down factors as well, but a lot of it is driven by the individual analysis that we as a team are doing, looking at individual stocks, and quite frankly, finding almost too many compelling buy opportunities versus things that are underperforming and that we wish to sell or recycle the capital. And I generally find that's quite a good sign in terms of the underlying performance of the portfolio. But also in terms of when we've been at this elevated level, we've been pretty high for most of this year. Actually, gearing did actually peak back in sort of February or March when we had that market fall post the US's actions against Iran. But when I look further back, it's been at this levels a few points in time, but not many. The last time we were sort of lower and brought the gearing up was really sort of the back end of 2022 and into 2023. We'd had fairly conservative gearing in through most of 22. We sort of brought that up through 23. But we have this range: 10% net cash to 20% geared, being 17% geared or 16% geared. Hopefully demonstrates the confidence that we as a portfolio management team are seeing in both the portfolio and the opportunities ahead.
Yeah, and I think we can all agree, and I'm sure our audience will agree as well. There's a lot of value out there in UK stocks right now, which is one of the reasons I'm sure that we've got this huge M&A wave. You were going to ask about that, James.
Yeah, exactly. Have any of your holdings been taken out this year, Guy? What are your general thoughts around the M&A picture?
Yeah, it's quite interesting, and it's all well and good for a portfolio manager who is managing a portfolio in a certain market say, "Oh, look at my market, isn't my market cheap?" Of course, people are often going to say that, but the level of incoming M&A, I think, does genuinely act as sort of external validation that a lot of these companies are just woefully underpriced. From a portfolio management perspective, it's one where I do feel somewhat sort of conflicted when bids come in, because first and foremost, from a relative performance perspective, I view it as a risk, because of course it's quite difficult at times to judge which companies might be subject to a takeover bid and which will be sort of perennial targets that are never taken over. And the size of the premium that can be achieved means that can have implications for relative performance. Within the portfolio, we have had we've had a few incoming bids so far this year. The most notable ones are all what I would describe as sort of M&A in process. I'm sure lots of people would have seen a couple of approaches that have been made to EasyJet. That is a holding in the portfolio. That's actually a holding that's relatively new to the portfolio, but we've obviously seen two bidders coming in there. So interesting to see some pricing tension. We had Rotork just last week being subject to an approach from ABB at a pretty sizable premium, and then I think it was just a day or two later, Mighty has agreed a potential bid. So those are three holdings which sort of just thought of, which have all happened, I guess, within the last month or so. So there is clearly a lot of activity coming in. I think it's really important, for us as the managers of the portfolio to think about, what price are we being offered? Is that an adequate or compelling enough premium for us to accept, or is it insufficient? And do we need to ensure that we're not selling off companies at too low a level? Of course, if something comes in with a knockout premium, that can be quite pleasing, but also it gives us an opportunity to recycle that capital. We take the premium today, and then we can recycle all that capital into some other great opportunities. And we're definitely not short of investment ideas in the portfolio.
No, and I guess because you do invest in quality growth companies with well capitalized and so on, they're exactly the kind of things that are being bid for at the moment.
Yeah, it's interesting. You've got, if you take Rotork as an example, it's definitely one of those sort of bittersweet ones. It's we've probably held it in the portfolio for we've probably held it for more than a decade. It's a business that we think we know very well. It's a very high quality business. It's got great earnings growth potential. It's got wonderful cash generation, etc. So of course it's one of those businesses that you want to keep in the portfolio, but if you're offered if we're offered a sufficient premium, then of course it is ultimately a financial decision.
And finally, dividends are an important part of the equation for Mercantile. So how confident are you in growing the payout above inflation?
I think dividends, they are a really important component of the return that we look to deliver to shareholders. Of course, the primary objective and the way we invest the portfolio is thinking about that long-term capital return, but we do think about the total return that investments are going to generate for us. And we've got I think a pretty decent track record on the dividends. So since the current policy was adopted, which is sort of over 30 years ago, the dividend has grown at a compound annual growth rate of about 8.5%, so well in excess of inflation. I think crucially as well, the dividend has never been cut. Even through GFC, post-Brexit, the pandemic, etc. There've been a number, Russia invading Ukraine. There've been a number of shocks to the system. We have continued to grow the dividend through lots of those events, and that has really been a function of the investment trust structure and the fact that we've got lots of income in reserves that can boost our dividend in slightly tougher times, but also reflects, I think, the cash generative nature of the companies in which we invest, and the fact, and this is really important, that they are not overpaying today. So when we look at the dividend cover of our portfolio companies, in aggregate, it's about 3 times covered. So that's really important because these are companies that are not struggling to meet up with the dividend expectations. They're generating a lot of cash. They can keep paying it out. And then, of course, ultimately, we're expecting our portfolio companies to grow their earnings quite significantly in excess of inflation. And so we have pretty high confidence that long-term growth trajectory can be sustained. But then importantly, in the event that there are short-term shocks, we've got pretty significant reserves in place, more than a whole year's worth of dividend in reserve, so that we're well placed. I think if we come into another pandemic style shock, the board can take confidence from the financial position and keep paying out.
Brilliant stuff. James, I think we're out of questions. So, Guy, I would just like to say thanks ever so much for coming on. It's been great to get your insights. And if anybody wants more information, just go to the Mercantile website, jpmorgan.com, and you'll find all the details of Mercantile on there. So with that, cheerio.
Thanks, Guy.